Welcome back to today's explainer. Look, if you've spent even 5 minutes looking into the trading industry lately, you already know the sheer volume of noise out there is completely deafening. It's like every corner of the internet is packed with these wild promises of making $1 million by tomorrow afternoon. But when we actually look at the data, a very, very different reality emerges. So today, we're diving into the Reality Check Trading Roadmap. This explainer is all about uncovering the fastest, most realistic, and honestly, the most structured path to actual sustainable profitability in the markets. We are totally stripping away the hype to focus entirely on the nuts and bolts of building a legitimate skill set from the ground up. Okay, let's dive into this. Focus on the process, not the profits. It sounds incredibly simple, right? Almost cliche, but psychology experts actually note this is frequently the hardest lesson for a trader to really internalize. The research actually suggests that obsessing over daily profits triggers these intense emotional responses that literally hijack your brain. If you're sitting at your screen just hyper-fixated on how much money you want to make today, you are way more likely to crash and burn. The real secret? You've got to focus relentlessly on executing a systematic process. When you do that, the profits just naturally become a byproduct of your discipline. So here is the literal map of our explainer today. We're starting with cutting through the noise, then mapping out the core roadmap, moving into mastering one strategy, building your risk management shield, and finally tackling trading psychology. Let's get into it. Section 1, cutting through the noise. Before we even think about pulling up a chart or talking about a single candlestick, we have to tackle the very first hurdle for absolutely any beginner. Surviving the absolute avalanche of bad advice and wildly unrealistic expectations you're going to encounter online. And this brilliantly illustrates that crucial difference. We're looking at the gambler's mindset versus the trader's mindset. There is a massive divide here. The gambler's mindset basically treats the financial markets like a shiny, flashy casino, bouncing from one strategy to the next, running purely on adrenaline and hope. Contrast that with the trader's mindset. This means treating your trading like a boring, highly structured, methodical business. It takes systematic practice, gathering data, and just an immense amount of patience. Honestly, if you start with that gambler's mentality, the market is going to gladly take your capital. Section 2, the core learning roadmap. Let's shift away from the theory for a second and look at the actual step-by-step progression every successful trader has to go through to build true, lasting skill. Take a real close look at this chronological roadmap. Phase 1 is mastering market basics, just understanding exactly how an asset even moves. Then Phase 2, committing to one strategy. Phase 3 is backtesting that strategy endlessly on historical data. Phase 4 is demo trading with fake money to test your execution. And only then, finally, do we arrive at Phase 5, small live risk. Notice how much time is spent on backtesting and demo trading before a single dime of real money is touched. The data shows us that skipping straight from Phase 1 to live execution is literally the fastest way to drain your bank account. Real skill comes from structured practice in these middle phases, definitely not from trying to take shortcuts. Section 3, mastering a single strategy. Now we're going to shift our focus to the actual mechanics of trading, specifically looking at how we read chart setups without getting distracted by 100 different blinking indicators. For our main example today, we're going to anchor on scalping. Scalping is a trading strategy entirely focused on profiting from really minor price changes over a very short time frame. We're talking minutes or sometimes literally seconds. Whether you're looking at super high volatility crypto assets like Bitcoin or more traditional markets like gold, scalping requires just immense laser-like focus. Because the price is moving in literal seconds, traders need a completely systematic approach so they don't just freeze up when the market suddenly drops. So here's exactly what that systematic breakdown looks like on a screen. First, you identify the overall market structure and trend. Like, are we consistently making higher highs or lower lows? Second, you spot the specific setup you've mastered. Maybe you're looking for a very specific hammer candle shape rejecting off a key support level in gold. And third, wait for confluence. By robotically repeating these exact steps every single day, pattern recognition just starts to become second nature to you. Now, what's really interesting about this slide is the concept of confluence. It's your ultimate filter against bad trades. Confluence happens when multiple technical factors align perfectly to support the exact same trading decision. So, for example, if Bitcoin hits a major daily support level at the exact same moment a volume indicator shows a massive spike in buying pressure, boom, that is confluence. It acts as a safety net against taking random, low-probability gambles. A really classic beginner trap is buying into a fake breakout. A Bitcoin candle might look incredibly bullish right up until the last 10 seconds, and then bam, it completely reverses, trapping buyers who jump the gun. That's exactly why waiting for the candle to actually close, checking the trading volume to make sure there's real market participation, and confirming the trend on higher timeframes is so vital. Knowing your exact entry and exit points before you ever even click buy is absolutely crucial for your survival. Section 4, Risk Management and Survival. You can have the most beautiful chart analysis in the entire world, but without this next element, failure is pretty much guaranteed. Think of risk management like carrying a heavy shield into battle to protect your vital organs. $20. It turns out this is kind of a magic number for surviving the transition to live trading. By starting out with ultra low risk, like literally just risking $20 on a trade, the goal isn't to double your account or buy a Lamborghini. The goal is simply to survive the terrifying, very real emotions of having actual money on the line while you're still learning the ropes. Let's contrast these two approaches. Over-leveraging has this dangerous emotional allure, but it carries a massive psychological toll and a huge risk of blowing your entire account in a single afternoon. Capital protection, on the other hand, acts as a professional, calculated shield. With strict, small risk limits, even if you have a terrible day and take 3 losses in a row, you still have enough capital surviving to comfortably come back and trade again tomorrow. And this strategy translates directly into building a long-term edge through a solid trading journal. Look, it's not just about jotting down dates or whether a gold or BTC trade was a win or a loss. The real magic happens over there in the review column. Rigorously logging your behavior highlights the recurring emotional mistakes, like entering a trade out of sheer impatience or revenge trading. Because once you actually see that pattern written down on paper staring back at you, you can finally start to fix it. Section 5, the psychology of execution. We are now moving to the final, and without a doubt, the most difficult layer of the trading pyramid, mastering your own mind. So, the crucial point is this hard truth. True trading skill is only 20% technical analysis and 80% patience and emotional discipline. Honestly, drawing lines on a chart is the easy part. Sitting quietly for 3 hours, ignoring that deep fear of missing out, and just waiting for the absolute perfect setup, that is what actually separates the consistently profitable professionals from the amateurs. Discipline is always going to overshadow simply knowing how to read a chart. To keep yourself grounded in this totally chaotic environment, there are some core psychological rules you absolutely need to follow. First, accept your losses gracefully. They aren't a reflection of your self-worth. They're just the simple cost of doing business. And if you do take a loss, absolutely avoid the dangerous urge to revenge trade just to win it back immediately. Stick entirely to your one mastered setup. Because at the end of the day, true wealth is built through boring, repetitive consistency. Wow, we have covered a massive amount of ground today. From cutting out that gambler's mindset to mastering a single setup, protecting your capital with a $20 shield, and logging your daily trades to fix those pesky mistakes. I want to wrap up this explainer by leaving you with a final thought to reflect on. What part of trading took you the longest to learn? Or, hey, if you're just starting out on phase 1 of the roadmap, which part feels the absolute most daunting to you right now? Take a second to really think about that, engage with the process, and always remember that real mastery comes from structured, disciplined practice over time. Thanks for learning with me today, and I'll catch you in the next explainer.